What if I told you that your brain sometimes tricks you into making money mistakes? Welcome to Winning the Mind Game, where we explore how our minds can quietly become the biggest obstacle to smart investing. In this episode, we'll look at what are investor biases, how biases affect investment decisions, and how the different types of investor biases can shape the way we see risk, returns, and market moves, often without us even noticing. Before we move forward, let's understand what a bias really means. Bias is simply a mental shortcut, a habit of thinking that feels natural but isn't always logical. And when it comes to money, these investor biases can quietly push us to take decisions that may not match our real goals. Think about this. During the pandemic, the market dropped sharply. Some investors panicked and sold everything. Others saw it as a chance to buy more mutual fund units at lesser price. Same market event, completely different reactions. Why? This is where the psychology of investing and the various types of investor biases come in. Today, we'll follow Raj, an everyday investor just like us. Inside Raj's minds are many different versions of himself, each shaped by a different kind of bias. Through Raj's story, we'll explore the different kinds of biases in investing and see how they quietly mess with our money decisions. Recency bias. The market fell 2% yesterday. It's definitely going to keep falling and I should sell everything right away. What is recency bias? When we place too much importance on what just happened and forget the bigger picture, that's recency bias. Yes, markets can fall sometimes. But over longer periods, like 5 years, equities have often recovered and delivered positive returns, even though there are many short-term ups and downs. It's like cricket. Your favorite batsman gets out for 0 once. That doesn't mean they've lost form forever. Among the different types of investor biases, this one is very common because daily headlines feel urgent, but reacting to short-term noise can hurt long-term gains. The smart move? Ask yourself if you're investing based on yesterday's news or your future goals. Confirmation bias. See, I knew equity funds were risky. Look at this negative news article I found. What is confirmation bias? When we only notice information that supports what we already believe and ignore anything that doesn't. That is confirmation bias. Raj thinks equity is risky, so he spots every scary headline and forgets all the positive updates. It's like believing a restaurant is bad because of one slow meal while forgetting all the great meals you've had there. This shows how biases affect investment decisions. We build an unbalanced view. A good habit is to ask, what am I missing? Try to read both sides before you decide. Loss aversion. I can't sell this fund now. It's down 5% from what I paid. I'll wait until it comes back to my buy price. What is loss aversion? It is when the pain of losing feels about twice as strong as the pleasure of gaining. This makes us hold on to underperforming investments just to avoid facing a loss. It's like keeping an old broken phone just because you paid a lot for it, even though a new phone might work better. Among the various types of investor biases, loss aversion can quietly trap money where it is not growing. A smarter question to ask, knowing what I know today, should I still buy this fund? Hoarding bias. Everyone in my office is buying tech funds right now. I should do the same. What is hoarding bias? It is when we follow what everyone else is doing, thinking the crowd must know something that I don't. But the crowd isn't always right. Think of trends that faded fast, like fidget spinners or sudden market fads. But the time everyone talks about it, the best days may have passed. This is one of the classic types of biases in investing. Instead of following the herd, ask yourself, does this fit my own risk level and long-term plan? Anchoring bias. This fund's NAV is only Rs 25. But that other fund's NAV is Rs 250. The Rs 25 one must be cheaper and better value. What is anchoring bias? It is when we fixate on the first number we see and let it guide all our thinking, even if it doesn't matter much. In mutual funds, NAV is just the price per unit. A lower NAV doesn't mean a fund is cheaper or better value. It just started at a different base. It's like choosing a smaller packet of chips because it costs less without checking how many chips are actually inside. This shows why it helps to look deeper than the first number and focus on what really matters: the fund's strategy, portfolio, and track record. Overconfidence bias. I'm sure I know which sectors will do well this year. I don't need diversification. What is overconfidence bias? It makes us believe we are better at predicting markets than we really are. Even professional fund managers find it hard to time markets perfectly. It's like feeling so sure you'll ace an exam that you don't revise properly. Among the different types of investor biases, overconfidence can lead us to take bigger risks than we should. A safer move? Stay humble, diversified, and let data guide your choices. Sunk cost fallacy. I've already held this fund for 2 years and spent so much time researching it. I can't give up on it now, even though it's not doing well. What is the sunk cost fallacy? When we stick to something mainly because we've already invested time, effort, or money, even when it no longer makes sense. That's sunk cost fallacy. It's like forcing yourself to finish a boring movie because you have already watched half of it. This is one of those investor biases that keeps us tied to poor choices. The smarter question to ask is, if I had fresh money today, would I invest in this fund again? Mental accounting. I'm careful with my salary money, but my bonus, that's free money to splurge. What is mental accounting? When we treat money differently based on where it came from, even though every rupee has the same value. That is mental accounting. Raj feels like his bonus is extra, so he spends it quickly, but guards his regular income carefully. It's like getting a cashback or gift voucher. You might spend it on things you don't really need because it feels different from real money. This can quietly hurt long-term goals because money is money, whether it's your salary, a gift, a tax refund, or a bonus. Better to ask, does spending this get me closer to my real goal? And for big bonuses or gifts, consider investing a part instead of spending it all. Among the different kinds of biases in investing, this one feels harmless, but over the years, just this one's choice can add up. Hindsight bias. I knew that fund would do well. It was obvious. What is hindsight bias? It makes past events feel predictable even if they weren't. After something happens, our brain rewrites the story. Of course that was going to happen. Raj didn't invest extra back then, but now it feels like he always saw it coming. It's like saying, you knew your friend would win the race after they have crossed the finish line. The problem? It makes us overestimate our skill and underestimate luck or market forces. A simple habit: write down why you invested something at the time. When you look back months later, you'll see what you really predicted and what just looks obvious now. Among the different types of investor biases, hindsight bias blocks real learning. Awareness brings humility and better decisions next time. Availability bias. I keep seeing news about tech stocks everywhere. They must be the best investment right now. What is availability bias? It makes things that are recent, loud, or dramatic feel more important even if they are not. It's like fearing plane crashes because they make headlines while ignoring road accidents which are actually far more common. For Raj, seeing articles and social media posts about tech makes it feel like the only good choice, but markets are bigger than what's trending. Why it matters? Availability bias can skew your portfolio towards what's popular, not what suits your goals. Better to step back and look at the real data, your risk appetite, and your timeline. Status quo bias. I'll just keep my money in the same fund I started years ago. Changing feels too risky. What is status quo bias? It is the comfort of sticking to what you already have even if it no longer fits your plan. It's like always taking the same road to work even when there's now a faster, safer route. For investing, this can mean missing out on better funds or keeping money in options that no longer match your goals. Here's a practical habit. Review your portfolio at least once a year. Ask, if I had to start fresh today, would I choose these same funds? If not, maybe it's time to adjust. Familiarity bias. I'll only invest in funds that hold stocks of brands I know, like my bank or my phone company. What is familiarity bias? It makes us feel safer with what we recognize. But knowing a brand as a customer doesn't mean it's always a good investment opportunity. It's like eating at the same restaurant every weekend. Comforting, but you know you might miss out on better places. In investing, this bias can make your portfolio too narrow. Instead, explore funds and sectors you don't know as well. After doing proper research, so you're not missing out on opportunities just because they are new to you. Self-attribution bias. My fund went up? That's because I'm good at picking funds. It went down? Well, that's market's bad luck. What is self-attribution bias? It means we take credit for gains but blame losses on outside factors. It's like saying you won a game because you're skilled but lost because of the referee. This feels harmless, but it stops us from learning what really worked and what didn't. Over time, that keeps you stuck at the same level. Better to ask honestly after every investment. What part was my decision and what part was the market? That reflection builds real skill. Bandwagon effect. Everyone is talking about small cap funds right now. I should invest too. What is bandwagon effect? It is similar to herding bias, but driven by popularity and social proof. When lots of people are doing something, it feels safe to copy them. It's like buying the newest phone because everyone else has it, even if your current phone works just fine. The danger? You might buy when prices are already high and panic sell when the trend cools off. What is a better move? Ask yourself, does this fit my risk appetite and time horizon? If not, it's okay to let the bandwagon pass. Present bias. I know starting my SIP now is smart, but I would rather buy that new phone. I'll start next month. What is present bias? It makes today's rewards feel bigger and more real than tomorrow's benefits. That I'll start tomorrow can quietly repeat for months or even years. It's like skipping study tonight to watch a match, telling yourself you'll catch up tomorrow. The fix? Automate your SIP investments so it runs even when you feel tempted to spend. Over the years, starting early makes a huge difference because compounding rewards patience, not perfection. These are the different types of investor biases that shape our choices daily, often without us realizing it. Knowing what are investor biases and how biases affect investment decisions is the first step to building habits that protect your money from your own mind.
An investor education and awareness initiative by Bandhan Mutual Fund.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.